Welcome to the fascinating world of value investing, where the goal is not just to invest, but to invest wisely in stocks that promise to double their worth. Did you know that as of last year, over 80% of the stock market's value is concentrated in just 20% of its stocks? That means there are hidden treasures scattered throughout the less traveled paths of the market, just waiting to be uncovered. In this series, we're going to dive deep into the secrets of identifying undervalued stocks. From the mystery of balance sheets to the telltale signs in cash flow statements, we'll uncover the crucial indicators that suggest a stock might just be worth more than its current price suggests. And yes, we'll even show you how dividends and earnings can whisper secrets about a company's real value. So, buckle up. Whether you're a seasoned investor or just starting out, you're about to learn some powerful strategies that could potentially double your investment. Ready to find out how you can spot these hidden gems before they become the talk of Wall Street? Let's get started. Chapter 1. The Hidden Gems, Uncovering the Market's Best-Kept Secrets. When diving into the world of investing, it's like exploring a treasure map where X marks the spot of undervalued stocks. These are the shares that the market hasn't fully appreciated yet, often because they're not the big names lighting up the news every day. Imagine finding a vintage toy in your attic that turns out to be worth hundreds. Some stocks are just like that, hidden gems waiting to be discovered. So, what makes a stock undervalued? It's typically a company with solid fundamentals that, for one reason or another, isn't getting the attention it deserves. These companies might be industry underdogs, or perhaps they're in a sector that's currently out of favor. Warren Buffett once said, "Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down." This approach is at the heart of value investing, buying stocks that are undervalued in relation to their true business value. One crucial tool for spotting these opportunities is the P/E ratio, price to earnings. If a company's P/E ratio is lower than others in its industry, it might be undervalued. But remember, a low P/E ratio isn't enough on its own. It should be the start of your digging, not the end. Another sign to look for is a disconnect between a company's market price and its book value. If the price you pay for a stock is less than the company's book value per share, you might just have stumbled upon an undervalued stock. It's like buying a dollar for 50 cents. Lastly, it's important to consider the broader market conditions. Sometimes, the entire market dips, and many stocks become undervalued. It's a perfect time for bargain hunting, but it requires courage to buy when everyone else is selling. As the saying goes, be fearful when others are greedy, and greedy when others are fearful. Chapter 2. Balance Sheet Detectives, Assets and Liabilities Deep Dive. Transitioning from the broad strokes of market trends to the nitty-gritty details, a company's balance sheet tells you a lot about its health and potential as an investment. Think of it as a financial snapshot that shows what the company owns and owes at any given time, like peeking into someone's financial diary. First off, check out the debt-to-equity ratio. This indicator helps you understand how much debt a company is using to finance its assets relative to the equity. A lower ratio generally means less risk. The company isn't relying heavily on debt to grow, which is a good sign for potential investors. Next up is the current ratio, which compares a company's assets to its liabilities. A current ratio greater than 1 suggests that the company can cover its short-term obligations without selling off any long-term assets. It's like checking if you have enough in your wallet to cover next week's groceries without dipping into your savings account. Another key figure is the quick ratio, sometimes called the acid test ratio. This metric strips out inventory from assets and compares the remainder to liabilities. It's a stringent test that shows if a company can meet its short-term obligations even in tough times, without having to sell off its stock. Unique facts and data can really illuminate these figures. For instance, did you know that historically, companies with a current ratio of less than 1.5 are twice as likely to face financial troubles? That's a statistic that can guide your investment decisions. While these ratios provide a strong foundation for evaluating a company, they don't work in isolation. It's essential to view them through the lens of the industry and the specific circumstances of the company. For example, tech companies often carry more debt, but that might be due to high growth expectations. In the end, becoming a balance sheet detective isn't just about crunching numbers. It's about piecing together a financial puzzle. Every figure tells a part of the story, and the more you practice, the better you get at seeing the big picture through the tiny details. Chapter 3. The Earnings Enigma, Decoding Profit Potential. When we talk about earnings, we're really peeling back the layers to see how much money a company is making. Think of it as trying to understand the health of a tree by looking at its fruit. The better the earnings, the healthier the company. Now, Earnings per share, EPS, is a good starting point. It shows how much money a company makes for each share you own. It's like knowing how many apples you'd get from your share of the tree. But here's the kicker: not all earnings are created equal. We need to look at quality, not just quantity. A company might have a high EPS one quarter due to a one-time event, like selling a piece of the business. That's why savvy investors also look at the price-to-earnings (P/E) ratio. If the P/E ratio is lower than others in the industry, it might mean the stock is undervalued. It's like getting those apples on sale. Another angle is earnings consistency. Companies that show steady earnings growth over the years are like trees that bear fruit regularly. They're reliable and likely healthier. Did you know companies with consistent earnings are less likely to run into trouble when the economy gets tough? It's because they've got a proven track record of weathering storms. Also, watch out for earnings quality. This digs into whether earnings come from core business activities or one-offs. High-quality earnings come from regular business operations, not the occasional windfalls. It's the difference between a tree that bears fruit every season and one that only does when conditions are just right. Chapter 4. Dividend Diamonds, the payouts that promise more. Now, let's talk dividends. Dividends are your share of a company's profits, paid out usually quarterly. If a company is paying consistent dividends, it's a good sign that they're financially healthy. It's like a tree that's not only growing but also able to share its fruits regularly. One strategy is to look for companies with a history of stable or rising dividends. It's a sign that the company is doing well enough to not only maintain but also increase what it pays back to its shareholders. Think about it: if a company is increasing its dividends, it's pretty confident about its future. Here's an interesting point. Historically, dividend-paying stocks have outperformed non-dividend stocks over the long term. That's because dividends provide a return on your investment regardless of market conditions. They're like a safety net when things get rough. Another factor to consider is the dividend yield, which is the percentage of the stock price you get back each year in dividends. But be cautious: a very high dividend yield might not always be a good sign. It could indicate that the stock price has fallen significantly, which could mean trouble. Finally, look at the payout ratio, which tells you what portion of profits a company is giving back as dividends. A healthy payout ratio is sustainable. It means the company keeps enough of its profits to reinvest in its growth, while still rewarding shareholders. Companies with very high payout ratios might not be saving enough for future growth, which could spell trouble down the road. Just like picking fruit, choosing dividend stocks requires a bit of know-how and a lot of common sense. You want to pick the trees that are not only lush but are also generous with their bounty. Chapter 5. Cash Flow Conundrums, where cash meets value. Cash flow is the lifeblood of any business. It's the actual cash that a company brings in from its operations, minus the money it spends. When you're looking at undervalued stocks, understanding cash flow is crucial. It's like making sure a car not only looks good but also runs well. One of the first things to look at is operating cash flow. This measures the cash generated from the company's main business activities. It's a great indicator of how well a company is managed day to day. A consistently positive operating cash flow is a sign of a healthy company. It means it's not just making profits on paper but is actually turning its operations into cash. Another important metric is free cash flow. This is the cash left over after a company pays for its operating expenses and capital expenditures. It's the money the company can use to pay dividends, buy back stock, or reduce debt. Companies with high free cash flow are like trees that not only grow tall but also have deep roots. They're stable and have the resources to withstand storms. Did you know that companies with strong free cash flow are often targets for acquisitions? That's because strong cash flow is a sign of a company's ability to generate value. Investors love companies that can turn a good idea or product into cash efficiently. Lastly, watch out for changes in cash flow trends. A sudden drop in cash flow can be a red flag, signaling potential problems ahead. On the other hand, a significant improvement might indicate that the company is on the upswing. Chapter 6. The Investor's Toolkit, Advanced Techniques for the Astute Investor. Now that you've got a handle on the basics, let's step up your game with some advanced techniques. The first tool in your advanced toolkit is the discounted cash flow (DCF) analysis. This method estimates the value of an investment based on its expected future cash flows, adjusted for the time value of money. It's a bit like calculating how much you would pay today for a golden goose based on the eggs you expect it to lay in the future. Another concept to understand is the economic moat. An economic moat is a sustainable competitive advantage that protects a company from its competitors. Think of it as a castle's moat that keeps competitors at bay. Companies with wide moats are great at keeping their earnings high and stable. Warren Buffett famously said, "The key to investing is determining the competitive advantage of any given company and, above all, the durability of that advantage." It's also crucial to evaluate management effectiveness. A talented management team can make all the difference. They navigate the company through ups and downs, always finding ways to maximize shareholder value. Consider this. Companies with high returns on equity, ROE, often have skilled managers at the helm. Finally, don't forget to combine these tools. No single tool can tell you everything about a stock. But when you use them together, they can give you a clearer picture of where a stock stands and where it might be going. These advanced techniques aren't just about crunching numbers. They're about thinking deeply about what makes a company special, how it earns money, and how it can keep doing so in the future. Use these tools wisely, and you'll be well on your way to finding those undervalued stocks that could double in value.